Welcome to TradeTheNBA.com. This is John. This report is for the 27th, and well, we're just cruising along. We had this reset of the shakeout, obviously from last week, well, a little bit before that. Then we started the rising, the shakeout again, and we had good reset from our DOC. This is where it's powerful to see those midterm, long-term buyers. That crossover into the new zone really made all the difference. And it's also caused the cyan shorts to continue to fade lower and lower. They're getting to a pretty low point here. We started to see some rise in that in the last day or so. So maybe they're feeling again that being over the 26 mark, that it's a little too much, and that's only going to fuel the next run, which would be to the 2680 range, which I think we may have a little more trouble getting to that. But at this particular point, the readings aren't bad. We are getting the beginnings of what we would consider a DOC spread, except for the cyan's crossing a little early here. Let me enlarge that so you can see a little bit better what I'm talking about. If you had the green, the midterm buyers crossing below the red, at the same time you have the cyan, we call that a DOC spread. It's kind of a nice short trigger. Usually works best though when you get the orange, both 13.5. Particularly on a breakdown of the checkout below zero, but sometimes it can happen off of an extreme setup there. In this particular case, we're not seeing any kind of move towards overbought here or even oversold. This is really kind of neutral. So I don't see much difficulty in this post-holiday, and it's still going to be late, holiday trade going in now until probably, we have a decent window here until about the middle of December that before things really start to flip from a active standpoint. And the NQ, likewise, breaking new highs and just confounding so many people, and I'm not sure why. It didn't seem to be that complicated. Really, the clear signal of it was right here. The euro. We talked about this. We get to the base. Market was having a little bit of trouble, and as soon as the euro started to rally, which was nice central bank involvement, and boom, skyrocketing the euro only means improved S&P because it bolsters the numbers. Not that numbers really have much to do with it at this particular point. It's about the potential for future inflation with growth, and that really comes down to it. Ironically, if you saw like a deal on DACA or something like that, you actually, that I think would be the catalyst to see the market fall, because some type of agreement on illegal immigration or increasing the flow of labor would certainly help the market in maintaining it. But if that doesn't work out and there's going to be a restriction in labor, then I would think that the market will start rising, because at that particular point they're going to realize that inflation is going to ramp up because of the labor shortage. So it's a mixed bag, because you're still going to have growth for corporations even with increased immigration. The difference is the inflation factor, and that will adjust what your market multiple is in a dramatic kind of way, because you've got to be ahead of that curve. If you're not, you're missing it. And this is where, looking at what the Fed's doing is sort of, I think, backward looking. It's not forward thinking. TLT, again, way elevated for what the potentials are, to suggest that, you're going to continue no interest environment with the market moving the way it is. The market's telling us that there's going to be a move in inflation, and you're just not necessarily paying attention to it. The move on oil is pretty extreme. It's suggesting, a significant kind of move. This is getting a little bit too much. The last time we saw a dip like this, with shorts, though, it continued the rally. So it's by no means a signal that things are going to fall. Every time that we've gotten shorts to this level, and this is a pretty extreme, with the cyan all the way below negative 7.5, it's only led to continuation. So this is a big move. This will also put inflationary pressures on, because remember, we always talked about the threefold. You needed a large amount of immigration, you needed oil prices to remain low, and no growth policies. Well, if you abandon all of those principles, then that is an exact recipe for inflation. So why isn't gold moving yet? That's a good question. I think you're starting to see the displacement of gold into some cryptocurrencies. So that actually is having I think, impact on it because digital currencies serve a similar function. So as you see exponential move in digital currency, some of that is being drawn from what would be gold from a hedge standpoint. I'm not sure that it's as liquid, but then again, gold really isn't all that liquid either. So they might see it as an opportunity to just move money around a little bit more freely. It just depends. There's still a large physical stake people take in metals. So you can see here we had the beautiful run, got up to our 100%, came exactly back down to the 50%, our normal expectation. Now, would this be 50% within someone else's normal trend? No, but that's not the point. The point is it is exactly to what we would see as an institutional setup, coming back through in this particular time frame and pushing right back to the highs. You see we're a little overbought, so we're probably going to retrace this post pre-market, which will put us right back down to the 26 marker, a little slightly below it. But all in all, I think we're just going to see more continued upward slant to where things are at, because what's your alternative? Again, this is ultimately the problem. Because rates are going to lag where the real market is, and because of this artificial nature thing, it sort of is forced capital. It's no different than tax reform, and even in the 80s, the changes in the real estate code, how it impacted where money moves, and that's really what we're gauging. And money can't really move out of the market into cash, because that would be kind of senseless. And now we're going to get into this secondary thing that we'll start talking about probably at the beginning of the month, will be those chasing the return of the S&P because they decided to go cash earlier and now are lagging in their return, and they're going to have to chase that return. So that could be the next stimulus to drive us further. So there you have it, long and the short of it. Ran a little long there, but that's okay. As always, though, we will posting relevant charts on the Twitter feed. Trade well.